Welcome to Breaking News to Trading Moves.
Great to be here.
Today we're examining a major announcement in the utility space. We want to take that headline, which is about a pretty large investment, and really translate it into what it means for the market.
Exactly. Who stands to benefit and, who might face some new challenges because of it.
The story really centers on American Electric Power, that's ticker AEP.
Right.
And their involvement with Bloom Energy. Ticker BE, AEP's subsidiary, announced a plan for a major purchase of Bloom's solid oxide fuel cells.
And the number attached to it is what's getting everyone's attention. We're talking about a deal valued at approximately $2.65 billion.
$2.65 billion. For anyone following this space, a number like that just changes the conversation.
It really does. I mean, this isn't some small pilot project or a government grant. This is serious infrastructure finance being applied to a technology that, that many people still viewed as being in an earlier stage.
Okay, let's pause there for a second. You said solid oxide fuel cells. For anyone listening, how is that different from other fuel cells we hear about, and why is that important for something on this scale?
That's a great question. So solid oxide fuel cells, SOFCs for short, they run at really high temperatures. Think 600 to 1,000 degrees Celsius.
Wow, okay.
And that heat gives them two big advantages for these industrial-type customers. First, they're just highly efficient. They're better at turning fuel into electricity than a lot of traditional methods.
And the second advantage?
The second one is key for the long term. They're extremely fuel flexible. They can run on natural gas today, biogas, but also they can run on high concentrations of hydrogen with very few changes.
Ah, so you're future-proofing the investment.
You are. For a 20-year project, that flexibility is everything.
All right, so tell us more about the project itself. Where is AEP putting this facility, and what does the deal actually look like?
The plan is for a new fuel cell power generation facility near Cheyenne, Wyoming. But the structure of the deal is what makes it so compelling. AEP has locked in a 20-year offtake agreement.
Oh, what agreement?
An offtake. It's a long-term contract to buy the power. And in this case, it's for the facility's entire power output.
The entire output for 20 years.
For 20 years.
So there's an unnamed customer here who basically needs a guaranteed nonstop supply of power. They want to be completely insulated from, the day-to-day volatility of the power market.
That's exactly it. You're probably looking at a massive data center or a large industrial plant where they just cannot afford to go down. They aren't just buying kilowatt hours. They're buying guaranteed reliability.
Hold on. Why can't they just go to their normal utility for that? I mean, don't utilities offer guaranteed power contracts all the time? What's the problem this setup is solving?
It's a matter of time and complexity. A utility can provide that power, but if you need to build out new transmission lines or get through a bunch of regulatory approvals, that can take years.
Shortcut.
It's an infrastructure shortcut. A dedicated on-site or near-site solution using fuel cells can be faster, it can have a better emissions profile, and it's protected from a lot of regional grid issues.
And that 20-year contract, that must completely change how you get the money to build this thing.
Oh, completely. For any big project like this, the biggest risk is always, will someone buy what we're making?
The demand risk.
Right. By getting a customer to sign on for 20 years before you even break ground, you've basically eliminated that risk. All of a sudden, the cost to borrow money to build it plummets. It becomes bankable. You can finance it like a toll road, not like a new piece of tech.
And to wrap up the deal details, what if something goes wrong? What if the project isn't ready by, say, Q2 2026 like they're planning?
AEP protected themselves there. The agreement says if the conditions aren't met on time, AEP gets compensated for all the capital and costs they've put in. It just shows how seriously this is being structured.
Okay, let's turn this into some market analysis. A $2.65 billion deal doesn't happen in a vacuum. There are going to be winners and there are going to be losers.
Sure.
Let's start with the beneficiaries. Category 1 seems pretty obvious. The fuel cell and distributed power companies themselves.
Absolutely. For Bloom Energy, BE, this is a landmark moment. The size of this deal is enough to make the whole market reevaluate what's possible for stationary fuel cells. It takes the conversation beyond just pilot projects.
Okay, but if this is such a big win for Bloom, how do their direct competitors also benefit? Aren't they all fighting for the same dollars?
That's a good point, but you have to think about sector validation. Before this, maybe some investors saw the whole fuel cell space as speculative.
A bit risky.
Bit risky, yeah. Now you have a major utility, AEP, using a classic infrastructure finance model for this exact technology. A rising tide lifts all boats, It lowers the perceived risk for everybody. So you look at companies like Fuel Cell Energy, that's FCEL, and Plug Power, PLUG,
So they're all operating in a market that now looks a lot more
a
mature.
lot more mature, and with a new high watermark for what scale looks like.
Okay, that's category 1. Category 2, you can build a new power plant without, well, building it. This gets us to engineering, construction, and grid interconnection.
Right. The most advanced tech in the world still needs concrete and steel. A facility of this size needs a ton of what we call EPC work: engineering, procurement, and construction.
Site prep, build out, installation.
All of it. And then the really critical part, connecting to the grid. That's not a simple plug-and-play operation. Given its location near Cheyenne, you're probably looking at some real upgrades to the transmission and distribution network right around that point.
So this creates years of work for certain companies.
Years of steady work for the big contractors. You're talking about companies like Quanta Services, ticker PWR, or Fluor, FLR, and Jacobs, which is J. These are the companies that build the physical backbone of our energy system.
Got it. Okay, third group of beneficiaries. This one is about what happens after it's built: the hydrogen, industrial gas, and equipment ecosystem.
This goes back to that fuel flexibility we mentioned. These solid oxide fuel cells are designed with the future in mind. They may start on natural gas.
But they're ready for hydrogen.
They are. And a deployment of this size creates an immediate need for all the associated gas infrastructure. It builds a clear pathway for them to start blending in hydrogen later on.
So even if the hydrogen isn't flowing on day one, the fact that the plant is there creates the demand for it down the line?
Precisely. And this pulls in the industrial gas giants, companies that produce, store, and transport these fuels. We're talking about players like Lind, ticker LIN, and Air Products, APD.
And the equipment suppliers, too.
Yeah, and Chart Industries, GTLS. They make the specialized cryogenic gear needed to handle these fuels. Their business gets a boost as these large-scale facilities get built.
All right, let's flip the coin. Every step forward in one technology can create some pressure for others. Who faces some headwinds from this?
Let's start with the backup generator and engine OEMs, the original equipment manufacturers. That's our first category.
So companies that make the big diesel generators we see everywhere, they've always been the default choice for reliable backup power. Why is this a challenge for, say, a Cummins or a Generac?
Well, those generator sets, or gensets, are fantastic for backup, for emergencies.
Yeah.
But they're often not ideal for continuous 247 prime power, especially in places with emissions rules. So if a big data center chooses a fuel cell solution for its dedicated continuous power needs, that's a whole fleet of traditional gensets they no longer need to buy for that same job.
It displaces the demand.
It does. It displaces demand where a clean, quiet, continuous operation is the priority, not just emergency standby. So the growth outlook is altered for companies like Cummins, CMI, Generac, GNRC, and Caterpillar CAT.
Okay, that makes sense. Let's move to category 2, the merchant and independent power producers, the IPPs. These are the folks who own power plants and sell electricity into the wholesale market.
Right. And the key idea here is something called marginal demand leakage. It's a bit of jargon, but it's important.
Break it down for us.
The IPPs, so companies like Vistra, VST, NRG Energy, NRG and Talon Energy, TLN, they make their money selling power on the open market.
And this AEP and Bloom deal has that 20-year contract for the entire plant's output.
Exactly. Think of the power grid like a giant food court. The IPPs are the restaurants, selling power to whoever comes by. This deal is like a huge customer deciding to build their own private kitchen right next door with a 20-year meal plan.
So that customer is never going to the food court again.
For 20 years, they're completely out of that market. Their demand has been taken off the table. For the merchant generators, losing even a few of these huge customers at the margins can affect prices and profitability.
Okay, last category of headwinds: conventional gas turbines and the companies with turbo machinery exposure. Where's the competition here?
It's in the fight for new builds. When a customer needs firm, reliable power, the traditional choice was often a small gas turbine installation.
But the fuel cell is now a direct alternative.
It is. And it often has advantages in terms of siting, it's easier to put in more places, and it has a cleaner emissions profile. So every time a customer chooses a fuel cell solution, that's a small gas turbine they didn't buy.
So it puts pressure on the companies that sell those turbines.
It does. It puts pressure on their share of the market for new power installations. We're talking about businesses like GE Vernova, ticker GEV, and Baker Hughes, BKR.
Okay, let's pull this all together. Based on this one AEP and Bloom announcement, what are the three main takeaways for you?
First, it's about the validation. The sheer scale of this deal provides real utility-grade proof for the technology. This isn't a science experiment anymore. It's real infrastructure.
Second,
Second, follow the money. The 20-year contract is the real story. It makes this feel like a low-risk infrastructure deal, not a venture capital bet on clean tech. That long-term contract is what gives investors confidence.
and the third takeaway.
The third is to watch for this to happen again. This deal sets a template. You should expect to see other large customers' data centers, big factories, looking at this model. They now have a proven way to structure these kinds of long-term deals for dedicated power.
That template is what could really change things. All right, let's leave you with a final thought to consider. With these huge customers now able to contract for their own power outside the traditional grid, sort of creating their own mini-grids, how does that affect the long-term planning and investment strategy of the big regulated power companies that have run the show for 100 years?
That is the challenge that will define the next decade for the utility industry.
We appreciate you joining us for this analysis. Please remember that the information and opinions discussed in this material are purely the opinion of the author of the underlying content. This is not financial advice or a recommendation to buy or sell any security.
Always consult your financial professional before making any investment decisions.